Welcome investors. Today is Tuesday, December 6th. We are Dynamic Wealth Management. My name is Gary Luna. This is Grant Haddon. Adam Carlini is also with us. And this is our video update where we talk about the stock market, the economy a little bit, and things that are important to you and your money. So far we've been on a great little rally. We'll see how long it'll last.
Yeah, in general, December is the strongest month of the year. Why is that? We're not exactly sure. A lot of times people credit that to a Christmas rally in retail. Maybe Trump has brought Christmas early this year. The market has been going up strong ever since he was elected. We'll talk about our views on that and what we see going forward. Let's jump into the charts. All right, thanks for joining us for our market update today on December 6th. We'll jump right into it and give you our opinions of what's happening in the economy and what's happening in the stock market. First, we want to let everyone know every other week here in our office we do a meeting called Investments for Breakfast. It is an educational meeting where we talk about the markets, what we see happening in the markets. We talk about the economy. So if you are a student of the markets or want to be educated a little more than you are on the markets, come to this meeting. It's an hour long, 9 o'clock a.m. every other Tuesday. We're skipping a week here for Christmas. So our next meeting will be this upcoming Tuesday, the 13th, and then we will not meet again until the 3rd of January. But anyone's welcome to come to that. We do that right here in our conference room. You can go to our website to find our address. We do investment seminars as well. We are doing a seminar in Sun City Grand on January 10th. That'll be a dinner seminar. If you're interested in that and finding out a little bit more about what we do, then please give us a call and RSVP to that seminar. Okay, let's talk about the economy and some key events. Obviously, the key event that has happened recently is that the stock market has been moving very strongly ever since Trump was elected. We found this picture online and we kind of got a kick out of it. I'm sure many of you have heard the rhetoric that is out there about the Trump train. Well, the big question is, has the Trump train brought Christmas early this year, as the stock market has moved very strongly ever since November 8th? Can it continue through the rest of the year? As we said in the intro, usually December is the strongest month of the year, averaging about a 2% return if you were to look back over the last 25 years. But the market right here is actually overbought. It's looking like it needs to pull back a little bit. So we will be very interested going into the Christmas season if the market can muster up a Christmas rally or if we're going to see a little bit of a pullback. Here are some key economic statements made by TD Ameritrade. Bonds have been selling off pretty hard, and that's really because of the expectation of higher interest rates. Interest rates have been going up, and there is, we'll show you on our next chart here, about a 90% chance that they will raise rates at their next meeting, which is upcoming on December 14th. This one is interesting. We want to focus on kind of the last sentence here. It says, this upcoming Thursday, the ECB is widely expected, and the ECB is the European Central Bank, is widely expected to announce a tapering plan. So just like we stimulated for a long time, Europe has been stimulating for a very long time, and they're talking about beginning to taper their stimulus. Well, what does that mean? That means that their currency would stop devaluing as quickly as it has, and that would probably hurt the dollar. So something that we're going to want to pay attention to there. And the last thing here is, again, everyone's expecting that the Fed will raise rates. This morning there was some payroll data that came out, and it was, the wording here was less rosy than expected, but it is unlikely to dissuade the Fed from raising the rates. So let's jump into that and let's look at the rates really quickly. Okay, so here is that chart that I was talking about. There is a 92.7% chance that the Fed is going to raise rates. Now, they base that on what they see happening out there in the bond market, kind of buying versus selling. And so the expectation is that they will raise rates. How much? We're not exactly sure. How many times will they talk about raising rates in 2017? We're not exactly sure. So all of that will play a strong, will have definitely be a strong indicator as what's going to happen with the stock market for the rest of the year. Last thing before we turn some time over to Gary to talk about the actual stock market is we wanted to talk real quickly about GDP. This is actually a very positive number. If you look at the range here of what was expected, they were expecting between 2.9 to 3.2% growth GDP, and we got 3.2%, the upper side of the range. And actually, that's the highest number that we've had in a couple years. So definitely some positive news there coming out of the economy. So even though the market has gone up for about 7 years in a row, there's still looks like there could be some legs to this market, like it can continue to move in a bullish manner, which is great for investments. I will turn some time over to Gary to talk about the stock market, and he will let you know how we're invested in our various models as well.
Good to be with you on this Tuesday. Let's talk about the stock market a little bit and what's going on there. We'll start off with a breakdown year-to-date of what's going on with the major U.S. indices. As you can see here, the one that is leading us on the upside is the Russell, or the small cap index, up about 19% year-to-date as of today. Then followed by the Dow 30 at about 10, and then you have the S&P and the NASDAQ. So notice that what is lagging here is the tech-heavy NASDAQ. In fact, you can see that it's bowed out on this uptick. And notice when all of this upturn happened is right at election day. So ever since that point in time, we've been on a crazy run as far as the stock market is concerned. And again, the small caps are leading us up, which we like to see because that tells us that there is an appetite for risk out in the marketplace. As we look back in the month that is just past November, we always ask ourselves, was it a risk-on or risk-off month? And to help us to answer that question, we look at the price action. So notice we're going to look at the S&P 500, the Dow, the NASDAQ again, and small caps. These are all U.S.-based indices, and they all did well except for, of course, the NASDAQ. So the NASDAQ has some room to pick up and run. Some of the talk that happened with our new president-elect as far as some trade renegotiation, especially with countries like China, that has weighed heavily on some of the NASDAQ companies. Notice that the U.S. companies have done much better than the U.S. companies have done much better than the international indexes. So this index tracks 20 to 25 of the largest developed countries in the world besides the U.S., which is actually down in November by 1.7. And then even worse as we look at emerging market international countries, which was down about 4.7. Also strong of late after the elections is the U.S. dollar, and that is probably one of the reasons is the idea of more inflation with infrastructure. That again is part of the plan. We'll wait and see if that actually holds true, but that's part of the plan. Commodities, especially energy, has done well of late. The things that have not done well are the interest-sensitive areas of the economy and the market. Real estate in the form of REITs was down, and of course longer-term bonds. We've seen long-term rates go up, and so of course price action on bonds, which is usually moves in inverse from rates, is of course going the other way. So with rates going up, price action on bonds has been down. Speaking of bonds, let's look at that in more detail, because that is an area of the market that has really been affected not only during the election, but even prior to the election. So we go back to July of this year, and that's where really rates bottomed out. This is the 10-year Treasury note, which is a key indicator for bonds, for mortgages, and all sorts of rates. And notice that it hit its bottom at the end of June at 1.3. Since that point in time, though, rates have really gone up. Now this chart is tracking the bond market on a weekly basis. So every one of these candlestick marks is showing that rates have really gone up, where some were sitting at about 2.45. So if you look at it on a percentage basis over the last 5-6 months or so, that is about a 70-80% swing as far as the yield is concerned, which is obviously substantial. Now we'll look closer at the S&P 500 and look at the technicals on the S&P 500 and see where we stand there. And so as you can see here, this is the big rally we've been on. So now we're back to a daily chart. Every one of those candlesticks represents a day in time. The green candlesticks meaning that we started lower, ended higher. Notice that we pushed above major moving averages. We're now on the 10-month or 10-day moving average, which is a strong uptick. And of course, we hit all-time highs just about a week and a half ago, and we are nearing that area again. Where do we go from here? Well, these type of trends, especially straight up that way, do not last forever, and we would not be surprised to see a bit of a pause. In fact, as we look at one of the indicators that we watch, the McClellan oscillator, it's showing us that we're more overbought than oversold, which is to be expected after a big swing upwards. And so we wouldn't be surprised to see the market slow down and maybe take a break, consolidate maybe in this area, and hopefully it continues to head higher after that with some of the positive news. So where does that leave us as far as our model allocations? Well, not a lot of changes of late, because as you can see here by one of our key indicators, this is the ratio of stocks to cash. Remember, this is not the actual S&P, but it takes into account the S&P along with shorter term bonds. And notice we were very close, and that was right around election time as well, where we were close to getting into that yellow zone, but we did not go there. The market improved, and we were able to ride that up for the most part in most of our models that were either at that time 60-40, 80-20, or 100% in stocks. So we are definitely in the green zone, and that's what our main indicator looks like. In fact, we have quite a bit of a cushion now into that green zone, and so barring some big change in the markets, we'll probably stay in the green zone for the next couple weeks. And what does that mean as far as allocations? Well, there's our major for our ETF core model, whether you're growth, moderate, or conservative. Let's take the moderate client. He is still sitting at he or she are still sitting at an 80-20 mix, 80% being risky assets, 20% being defensive assets. As far as one of our other tactical models, our sector rotation model, these are some of the holdings. And remember, those will be changed out at the beginning of the year. So this will be the last month, and then we will change according to the rules of that model. We have, again, 16 different sectors and industries that we can pick from. We rank them based on volatility and based on performance. And then we take the top 8. Those that do not are not ahead of their own 6-month moving average are not eligible for picking into that universe. And with that, we finish out this video. We thank you for your time. Please give us your feedback. Let us know more information you'd like to see. And we'd love to have you visit us for our investments for breakfast or our formal seminars as well. And with that, we'll let you go and look forward to talking to you again in probably a couple weeks.